Welcome, listeners, to today's deep dive into the world of dividend stocks, a cornerstone for investors seeking steady income in an ever-evolving market landscape. As we speak on September 15, 2025, U.S. markets are riding a wave of record highs, with the Nasdaq and S&P 500 leading the charge. However, the Federal Reserve's looming interest rate decision is casting a long shadow, creating a backdrop of anticipation and potential volatility. In such times, dividend stocks, those reliable income generators, become an attractive option for investors looking to balance growth with stability. Today, we'll analyze three compelling dividend stocks highlighted in a recent report: J&J Snack Foods, Beacon Financial, and Interpublic Group of Companies. We'll explore their market impact, sector-specific dynamics, and practical advice for investors considering adding these names to their portfolios. By the end, you'll have a clearer picture of whether these stocks align with your financial goals in this dynamic economic environment. Market impact: dividend stocks in a high-stakes environment. The current market environment is a fascinating mix of optimism and caution. The S&P 500 and Nasdaq have been hitting record highs, driven by technology and growth stocks, but the Federal Reserve's next moves could shift the tide. Historically, dividend stocks have served as a safe haven during periods of uncertainty, particularly when interest rates fluctuate. Higher interest rates, which many analysts anticipate in the near term, tend to pressure growth stocks but can enhance the appeal of dividend-paying companies, especially those with stable payouts and strong fundamentals. Looking back, the 1970s and early 1980s offer a historical parallel. During that period of high inflation and rising rates, dividend stocks in sectors like consumer goods and financials outperformed, as investors sought income to offset economic uncertainty. Today, with inflation cooling but still above the Fed's 2% target, and with global supply chain concerns lingering, dividend stocks could play a similar role. The three companies we're discussing, J&J Snack Foods, Beacon Financial, and Interpublic Group, operate in distinct sectors, each with unique exposure to these macroeconomic forces. Globally, dividend stocks remain a critical component of portfolios, particularly in regions like Europe and Asia, where aging populations prioritize income-generating investments. In the U.S., dividend-paying companies have historically accounted for a significant portion of the S&P 500's total return, over 40% since the 1930s, according to some studies. As we navigate 2025, these stocks could provide a buffer against potential market corrections, especially if the Fed tightens policy more aggressively than expected. Sector analysis: breaking down the players. Let's dive into the sectors these companies represent and how they're positioned in today's economy. J&J Snack Foods, consumer staples, snack foods, and beverages. J&J Snack Foods, with a market cap of $2.02 billion, operates in the consumer staples sector, a defensive haven known for its resilience during economic downturns. The company's revenue streams: $1 billion from food service, $377.13 million from frozen beverages, and $218.36 million from retail supermarkets, reflect its diversified footprint across food service and retail channels. Its 3% dividend yield is modest compared to top-tier payers, but its decade-long track record of stable and growing dividends signals reliability. However, there are challenges. The company's high cash payout ratio of 91.3% raises concerns about dividend sustainability, as it leaves little room for reinvestment or unexpected downturns. Recent strategic downsizing, aimed at saving $15 million annually, could bolster financial flexibility, but it also suggests operational pressures, possibly from rising input costs or shifting consumer preferences. The consumer staples sector is grappling with inflation-driven cost increases, which could squeeze margins if companies can't pass costs to consumers. Still, J&J's recent dividend increase shows confidence in its long-term cash flow generation, making it a solid, if not spectacular, income play. Beacon Financial, financials, banking. Beacon Financial, a $2.17 billion holding company for Beacon Bank and Trust, offers a 5% dividend yield, placing it in the top 25% of U.S. dividend payers. The financial sector, particularly regional banks, has been under scrutiny as interest rate hikes boost net interest margins, but also raise concerns about loan defaults in a slowing economy. Beacon's $345.39 million in revenue from its banking business reflects a focused operation, but its recent merger with Brookline Bancorp introduces both opportunities and risks. The merger could enhance scale and geographic reach, but integration costs and a recent $86.89 million shelf registration for employee stock ownership plans signal potential dilution. With a payout ratio of 61%, Beacon's dividends are well covered by earnings, a positive sign for sustainability. However, the financial sector faces headwinds from potential regulatory changes and economic slowdowns, which could impact loan growth. Historically, banks with strong balance sheets have weathered such storms, and Beacon's high dividend yield makes it an attractive option for income-focused investors willing to navigate merger-related uncertainties. Interpublic Group of Companies, Communication Services, Advertising and Marketing. Interpublic Group, with a $9.67 billion market cap, operates in the communication services sector, a space heavily influenced by digital transformation and advertising spend. Its revenue segments: $4.03 billion from media, data, and engagement solutions, $3.39 billion from integrated advertising and creativity-led, and $1.43 billion from specialized communications and experiential solutions, highlight its diversified exposure to global marketing trends. Its 5% dividend yield is competitive, but concerns arise from dividends not being fully covered by earnings and a high reliance on one-off items impacting financials. The proposed merger with Omnicom could reshape the company's future, potentially creating a global advertising powerhouse, but also introducing integration risks. Declining profit margins and recent debt restructuring add to the uncertainty. The communications services sector is highly cyclical, tied to corporate budgets that can shrink during economic downturns. Yet, Interpublic's global reach and exposure to digital advertising, a sector projected to grow at a 10% CAGR through 2030, offer long-term potential. Investors must weigh these growth prospects against near-term dividend sustainability risks. Investor advice: building a dividend portfolio in 2025. For investors considering these stocks, here's practical advice tailored to different risk profiles and goals. For conservative investors, J&J Snack Foods is the safest bet among the three, given its defensive consumer staples positioning. Its 3% yield may not dazzle, but its low payout ratio of 3.1% based on earnings and decade-long dividend growth make it a reliable income source. However, monitor its high cash payout ratio and ensure its cost-saving measures translate to improved cash flows. Allocate 20 to 30% of a dividend portfolio to consumer staples like J&J to balance risk. For income-focused investors, Beacon Financial's 5% yield is a standout, and its 61% payout ratio suggests earnings can support dividends. However, the merger with Brookline Bancorp introduces uncertainty. Investors should conduct due diligence on the merger's progress and potential dilution from the ESOP filing. Consider a 15 to 25% allocation to financials, diversifying with other regional banks to mitigate company-specific risks. For growth and income investors, Interpublic Group offers a compelling 5% yield and exposure to the high-growth digital advertising sector. However, its cyclical nature and merger-related risks with Omnicom require caution. Limit exposure to 10 to 15% of your portfolio and pair it with less cyclical dividend payers to balance volatility. Keep an eye on profit margins and debt levels post-merger. General tips: diversify across sectors. Combine these stocks with utilities or healthcare dividend payers to reduce sector-specific risks. Monitor interest rates. A hawkish Fed could pressure valuations, but dividend stocks with strong fundamentals can weather the storm. Reinvest dividends. Use a DRIP dividend reinvestment plan to compound returns, especially for long-term investors. Stay informed. Track merger developments for Beacon and Interpublic, as well as J&J's cost-saving outcomes via earnings reports and industry news. Conclusion: a balanced approach to dividend investing. As we wrap up, dividend stocks like J&J Snack Foods, Beacon Financial, and Interpublic Group of Companies offer a blend of income and stability in a market poised for potential shifts. Each company brings unique strengths: J&J's defensive positioning, Beacon's high yield, and Interpublic's growth potential, but also carries risks tied to cash flow coverage, mergers, and sector dynamics. By carefully allocating capital and staying attuned to macroeconomic trends, investors can harness these stocks to build resilient portfolios. The Federal Reserve's next moves will undoubtedly shape market sentiment, but dividend stocks have historically proven their mettle in turbulent times. Whether you're a conservative investor seeking safety or an income-focused one chasing yield, these three names deserve a closer look. Stay disciplined, diversify, and keep your eyes on the long game. Until next time, this is your host, signing off with a reminder: invest wisely and let your dividends work for you.